Hello and welcome to Intro to Financial Statements. In this video, we are going to go through the three main financial statements that we normally use in a bookkeeping business or for accounting, how the accounts in our books make up those statements, and how transactions hit those statements in different ways to give us accurate reporting. I will preface this by saying this is definitely an intro to financials, and I've kept it very basic and high level, but we felt like it was really important to have the fundamental knowledge piece done first so that in the coming weeks and months, we can kind of build on that with more detailed ways to analyze financials, ratios, different ways you can use them. So that's all coming. If you have taken, an accounting course or a bookkeeping course, this might be a refresher, but it's still some really good fundamentals to know when looking at financials and how all the pieces work together. So let's dive in. This is what it looks like when you open it up, and we're going to do a quick walkthrough of the core concepts that are kind of the essential foundation you need to build your bookkeeping skills on. So the first piece is the types of accounts that you'd see on financial statements. So you have assets. Those are the things that your business owns, like cash, equipment, receivables. There's liabilities. Those are the things the business owes, like IOUs essentially. So loans, bills payable. You have equity. Those are things like the owner's investment in the business. So things like money that they invest directly for like buying shares or profits earned over time. So as time passes and the business earns profits, those are getting stacked up in owner's equity, building the value of the company. There's revenue or income, which is money earned from sales or services. We have cost of goods sold accounts. Those are direct costs to produce a good or service. And we have expense accounts. So costs to run the business, like rent, utilities, advertising. So there's three kind of like main financial statements that we tend to look at when we are showing financials to clients or looking at financial information. First one is the balance sheet. So this statement shows the financial position of the business at a specific moment in time. So like as of the year end, December 31st, 2025, or as of today's date, it would be showing exactly what's sitting in there as of today. So this includes any accounts that are considered assets, liabilities, or equity. And the balance sheet is following a fundamental equation, which is assets equals liabilities plus equity. And this just means that what the business owns minus what the business owes to someone equals the owner's share or value in the business. And it makes sense because you kind of think about it as, let's say I close down my business tomorrow, I would have all the things I owe that I'd have to pay off with my assets, and any assets remaining would equal the equity or the value left in my business once I've like settled my debts. That's how I kind of like to think about it. So if we go to our accounting reporting, obviously under reports in whatever accounting system you use, there's a ton of options. So we're no longer just doing these like three main reports. There's tons of different ways to look at the information that you have in your accounting system. But those three main ones, so you have the balance sheet. You can see at the top here, it says as at June 30th, 2025. So it's telling you right at the top that this is at a point in time. So as of, you can actually change these dates. So I can make it a different period. And you can see nothing happened. Nothing changed because it doesn't matter what the period is. The only thing this report is taking into account is this ending date of June 30th. So it's showing me my asset, my liabilities, and my equity. And as you can see, there's obviously an even more detailed breakdown of these accounts. You have things like current assets and property, plant, and equipment. You can get a lot more specific, but the main ones, assets, liabilities, and equity. And we can see that the assets in this example are $44,379. And if we go to the bottom, our total liabilities and equity are the same. So it's balancing. But you can see that it's still following that rule that if I paid off all my liabilities of $27,000 with the assets I have, I'd have, this equity portion remaining and added together. It's assets equals liabilities plus equity. So the one piece I want to point out here is in the equity section, we see profit for the year. This is how your balance sheet and your income statement tie together. So the income statement clearly shows the business's performance over a specific period of time. So instead of just looking at one specific date, we're looking at a period. So what happened in June or what happened last fiscal year for the whole period? It includes all the accounts that fall under revenue, cost of goods sold, and expenses. And it calculates net profit or loss, which flows right into that retained earnings line in your equity section of the balance sheet. So it's directly increasing and decreasing that owner's share in the business. So as the profit and loss statement or the income statement changes, things are happening, it's directly impacting equity, which is how it pulls everything together to the balance sheet. So if we look here, okay, so we can see at the end of June, we have this $16,727 and some change profit. So if I go back, and this is for the year, just remember, this is for the fiscal year so far. So if I want to see that in my P&L, I'm going to look at this fiscal year to last month, and it should be the exact same number. Perfect. So it is. That's 16,727. So that's how the year's profit ends up on the balance sheet. And when the year's over, it pushes that number out of profit and it puts it instead under retained earnings. So each year it goes into that bucket of retained earnings. So as years pass, retained earnings goes up and up and up and up, hopefully. And then profit is pulled out for just this current specific fiscal year. If I go back to my profit and loss statement, I can see that I have my revenue or my income accounts, sales, and I have my expense accounts here. There aren't any cost of goods sold accounts in here, but that would essentially be treated the exact same as an expense account if you were using that type of account to directly record those direct costs for producing income. So essentially, we're saying how much money did we bring in? How much money did we have to push out from operations of our business equals our profit or loss from operations. And the reason I'm saying from operations is because things like, for example, a loan to your business, it is technically bringing money into your business. It's a loan, but it's not earned money from operations, so it won't show up on our profit and loss statement. So the final statement we're going to look at in here is the cash flow statement. So this is showing how cash is moving and being utilized in the business over a specific period of time. It reorganizes accounts from the income statement and the balance sheet. So all of those accounts you saw up there, asset, liability, revenue, expenses, all those types of accounts can all show up on the cash flow statement in a reorganized way. It connects to net income in the sense that at the top, you have your net income at the top of your cash flow statement. And then it's adjusting for transactions where cash didn't actually move. So we'll take a look at this one, but there's 3 sections usually that you see in there. There's your operating section. So that's things like the daily business activities. So again, from operations, like cash collected from customers, payments to suppliers. There's investing. So things like buying or selling long-term assets, such as equipment. So, you buy that big piece of equipment. You're not fully just hitting your profit and loss statement with that, but you are still paying cash to get it. And then there's the financing piece, which is money coming in from loans, loan repayments, or contributions from the owner. So in that example where you're getting cash from a loan, that's not going to hit your profit and loss statement because that's not part of operations, but you still got cash. So it would be on your cash flow statement. So here's an example of a cash flow statement. We can see again that we have that 16,727 as our starting point, and then it is pulling in and taking out any non-cash items. So for example, accounts receivable. It's pulling this out because it's saying, yeah, while you do have this money being owed to you, you don't have the cash yet. So in our income statement, we recognize this $6,000 of revenue saying someone bought this and they're going to pay me for it. But in our cash flow statement, it's pulling it out to say they're going to pay you, but they haven't yet. It takes in and pulls out anything that reflects what actually happened for cash. So again, for example, I have this prepaid expense. So when I prepaid it, I gave cash away, but it's not being recognized on my income statement yet because I haven't incurred the expense yet. At the bottom here, you see this cash at the end of the period, $33,188 as of the end of June. And that directly should connect to your balance sheet. So when I go to look at my balance sheet, I would expect to see that my cash and cash equivalents are that 33,000. Total cash and cash equivalents, 33,188.99. So the cash flow is taking my profit, doing all those things, and equaling it to my cash. So that's just a really nice, easy way to see, okay, while your client might have profit in their company, do they still have cash available? Or vice versa, profit doesn't always equal the cash that's available in the business. The next thing I wanted to touch on is cash versus accrual. So you might notice that in these accounting softwares that we can use today, there's sometimes an option to turn it on or off to accrual. And what that essentially means is that if you turn on accrual, that's your transactions are being recorded when they happen. So it doesn't take into account if the cash has moved hands. It only takes into account if the event has happened. So that example of selling something but not collecting the cash yet. So in that sales example, if you sold something and gave your customer 30 days to pay, the transaction took place when you sold it and you'd recognize the sale, but you wouldn't recognize the movement of cash until maybe the next month. So accrual takes into account when the transaction happened, the sale was made, whereas a cash basis would take it into account only once cash has moved hands. So most businesses use the accrual basis, and that's what accountants use. That's what follows GAAP, generally accepted accounting practices. And that's what has the most value for business owners because you're showing operations in a way where income and expenses are being matched to the correct period of when the transaction actually happens. And it's giving more of a clear view of the operations of the business and not taking into account maybe, I don't know, that you have a customer who's not very good at paying. That is still an issue. It's just a different problem. So we want to be able to see those two things clearly. For a cash basis, those transactions are only recorded when the cash moves. So if you choose this option, it's really simple, but it's not really right for accounting. And we have the tool of the cash flow statement that we can use if we want to see the cash side of things. And then we can leave our income statement and balance sheet and all those other things in the accrual basis so we can actually see what took place in the period. Okay, so transactions. So how are these financial statements getting built out? Well, they're all built directly from the transactions that we're entering into our books. Transactions are showing what real life events are occurring and happening in the business. So every transaction has to hit at least 2 accounts. Some can hit more. What I like to think of it as like a give and take kind of relationship between the 2 accounts. So for example, I'm giving a service and I'm getting cash for that service, or I'm giving a promise to pay and I'm getting supplies for my business. That's like maybe I bought supplies on a credit card. So if you think of it as, those debits and credits as up or down, good or bad, it doesn't work because it's not really like that. You have to think of it more as like a give take, 2 sides, ebb flow. And one account gives, another takes, and that's essentially called the double entry bookkeeping. So if you hear that double entry, that's kind of what they're talking about is the 2 sides to every transaction. So we want to clearly track our transactions using debits and credits. Debits you're always going to have on the left side of your entry. Credits are on the right. And they always have to balance. And the one nice thing about accounting software these days is it forces you to make them balanced. It won't let you hit the button if they don't. Depending on the type of account is depending how it's going to react when you either debit that account or credit that account. So some accounts, when you debit them, they increase, and some accounts, they decrease. And I'll show you what I mean as we go through this. But a really easy acronym that I like is ALLCREW, and it's just an easy way to remember how the different accounts react to debits and credits. And if you haven't seen this before, it'll make more sense as we go through. So for example, you can see at the top here, I have the acronym ALCREW. So A is assets, L is liabilities, C is capital, which is like another word for equity for the acronym. R is revenue, E is expenses, and W is withdrawals or like owner's draws. Think of that as like dividends. The owner taking money from the company. You can see, so for an asset, a debit will increase it and a credit will decrease it. So if I have a bank account with cash in it and I debit that account, that's an asset account, it will go up. But if I have a revenue account, you can see the R. If I debit my revenue account, that'll actually go down. So this is just showing you how the different accounts react to debits and credits. And I have found myself writing this out on a piece of paper, trying to figure out what will happen to each account if I, make an adjustment. So we're going to do a couple examples together. Each journal entry takes what's happening in real life, and we clearly want to record it in the books. So in our accounting systems, we can see that it doesn't really look like a journal entry these days. So you can go new journal entry, and this is maybe something that we're used to seeing. You can see there's a debit side and a credit side. So let's say we want to debit $100 and we want to credit $100. Oh, firstly, that doesn't balance, so it won't let me save it. But if we go through this first example, we'll just do a basic journal entry of how we would record it. So my first example, I say you're going to buy $550 of office supplies and you're going to use cash in the business. So if we do that, we're going to buy supplies And actually, let's work through what that is. So we're buying $50 of supplies using cash. So as you can see, supplies would be an expense account, supplies expense. If we go up here, we can see that an expense to go up. So we're buying supplies, we're getting more supplies. Our expense is increasing, so we're going to debit it. So we know supplies will be the debit side of our entry. Supplies, sure. And then we are using our cash to pay for these supplies. So cash is an asset. Our cash is going down. So let's see what happens when an asset goes down. If I have an asset that goes down, I credit it. So you can see that I have now my two sides of my entry. Cash. There we go. So we can save this. And now we can see that we have a debit to photo shoot supplies, increasing our expense. And we also have a credit to our asset, decreasing our asset. So we've got supplies and we gave up money for the supplies. So another example is you sell a service for $200 and you invoice a customer who's going to pay you later. So in this example, I'm actually going to use the features in QuickBooks that I would usually use to record a sale. So let's say I'm going to record a sale. I have an invoice. I'm going to create an invoice and I'm going to do my customer, say ABC customer. I'm going to select a product. And I sold my service for $200. So as you can see in this example, it looks a lot different than my journal entry. Okay, so there. So I just recorded my sale. Easy. But I don't really get a good idea of what's happening in the background. So even though you're not doing this same like journal entry piece, that was what we almost had to do for everything back in the day, it is still doing this for you. That's what the software is doing. So if you go to this More button below, and every single accounting software has this, it's just like in different places, there's this transaction journal button. And this is so helpful if you want to see what is going on in the background of everything you do. So whether you're using the invoice module, the sales module, maybe you're using the AR AP modules, you're using a supplier section or the payroll section. This will allow you to see in the background what the accounting software is actually doing, which can be really helpful if you're like, oh, was that right? So we can see here, there was a debit to accounts receivable for $200 and a credit to sales for $200. So let's see if we think that's what we wanted. If I go back here, so we sold a service to a customer who's going to pay later. So it's going to hit accounts receivable. That's an asset account because I have something of value that's coming to me that I can cash in for $200. So if I go to my asset, I want to say my asset is going up because I'm going to get money for my service. So I need to debit my asset. And I'm selling a service, revenue. So if I go to my revenue account, I want that to go up as well because I'm increasing my revenue by selling something. So I'm going to credit it. So you can see that they kind of play on the two sides of each other. The asset increased as well as the revenue. And they perfectly match that give-take two sides of the entry. And we can see that in the background here. So you can actually go into any of your statements now and see exactly how your transactions are building out these statements. So if I go to my profit and loss statement, if I go to that same photo shoot supplies account, I can see exactly how my journal entry hit that statement. Or if I go into my sales, I can see that I now have this $200 transaction making up my statements based on those journal entries. So some final common misconceptions about financial statements is one, that the accounting software makes sure that it's always accurate. While it makes sure that your books do always balance, it's not necessarily accurate. As we've seen, there's a bunch of things that can go wrong or have to be fixed. But using that transaction journal feature has saved me so many hours, just because sometimes you'll look at your statements and you're kind of trying to figure out why an account has a balance, what happened, and what that underlying journal entry was that made that balance change. So that transaction journal feature saves so much time. Another misconception people sometimes have is that profit equals cash. If you're doing accrual accounting, which you probably should be, or accrual bookkeeping, profit does not equal cash. You can be getting cash from things that have nothing to do with your operations. So it's always good to look at both of those statements when you're trying to help your client understand what happened in their business, if they need to get, more cash from another source, if they're going to be able to make their payables, those sorts of things. You always want to make sure you're looking at both those statements. And the other thing that sometimes people think is that equity equals cash. So equity, as it accumulates and shows up in that retained earnings piece on your balance sheet, it's really just the accumulation of profit over the years. So while it shows the value of it's in the business, it's not directly related to cash on hand. So hopefully that helped break down a little bit of the basics of those first three types of financial statement and how they kind of tie together. And we're just going to keep building